Robert had everything you'd want in financial professionals. He had a sharp CPA who saved him thousands every April. He had a skilled investment advisor who beat the market 3 years running. But somehow he was still paying $47,000 more in taxes than he needed to. My name is Chris McClure, and for the past 30 years, I've worked with successful people who have great advisors, and I've discovered something interesting. The biggest tax problems, the biggest tax leaks, they don't come from bad advice. They come from good advice that isn't coordinated. You see, Robert owned a manufacturing business and had built a solid portfolio. He had $8.2 million across different account types. His CPA was excellent at business deductions and year-end planning. His investment advisor was generating strong returns and keeping fees low. But nobody was looking at how those two pieces fit together. Robert's advisor had him holding municipal bonds in his 401k, which made sense for portfolio balance, but those tax-free bonds were sitting in an already tax-deferred account, and that was wasting their main benefit. Meanwhile, his taxable account was loaded with dividend-paying stocks and actively managed mutual funds that were kicking off huge distributions every December. So his CPA would see the tax bill each spring and suggest ways to reduce it. But by then, unfortunately, the damage was already done. You see, that's where I see the biggest tax leaks. When we coordinated both professionals, we found opportunities hiding in plain sight. We moved municipal bonds to his taxable account. Inside that taxable account, their tax-free status actually mattered. And we shifted growth stocks to his retirement account where they could compound without creating annual tax bills. And we actually started harvesting losses in his taxable account, selling underperforming positions to offset gains somewhere else. And the result was Robert's portfolio returns stayed roughly the same, but he saved an annual tax bill of $47,000. And his reaction was that I can't believe this was sitting right there the whole time. My CPA is great, my advisor's okay, but nobody was connecting the dots. And this happens more than you think. And that brings up a problem we see with nearly every significant portfolio. And I'll tell you about it. Margaret faced a different version of the same problem. She had $12 million across IRAs, a brokerage account, and some inherited assets. She had some excellent professionals managing each piece of the puzzle. But when we looked at the entire picture, we found she was accidentally creating her own tax problems. Her investment advisor was rebalancing quarterly, which makes sense, especially for risk management. But every rebalance in her taxable account, it triggered capital gains taxes. Her CPA was focused on minimizing current taxes, so Margaret was maximizing her 401k contributions. But at 58, she was already heading toward massive required minimum distributions that would push her into the highest tax bracket. So we worked with her team to coordinate a better approach. Instead of frequent rebalancing, we used new contributions going in and withdrawals to maintain her target allocations. We started strategic Roth conversions to spread out the tax impact over time, and we positioned her assets so that the accounts with the best tax characteristics held the investments that would benefit most. So Margaret's investments kept performing well, but now her tax strategy and investment strategy, they were working together instead of against each other. And so when you see this coordination like that in action, the impact is immediate. And so if you have assets across multiple account types and you want to see coordination opportunities might exist, there's a link below that you can actually schedule a call. I think you'll walk away with insight about your specific situation, and I think it'll be a fun conversation. I really love making these videos, and I hope you'll join me on the next one.